Hello, everyone, and welcome back to the new Blueprint strategy course. Last time we started talking about valuation and we applied the valuation, the cross-market conditions on stocks and bonds. And today we're going to continue where we left off last time. So within our infinite markets, we still have to cover Forex. And on top of that, we also want to check how the valuation may also play a role to our finite markets, okay, as a secondary tool. And what we're going to do, of course, is we're going to continue to work on our blueprint cheat sheet. And today we're going to start about euro. We're going to start about talking about maybe the Japanese yen as well, even though we may already have them up here, right? So what we can do now on our valuation is we can add to that here as we look at the US dollar here, for example, we can just add another metrics here in terms of whether that's our primary or secondary tool. We'll check that. And then also we'll check on how gold, for example, as a valuation metrics, as a cross-market condition may play a role for our commodities like wheat, silver, or palladium. So without further ado, let's just jump straight into the charts. There's not going to be a lot of PowerPoints today. I'm sure if you're up to date, then you understand what the valuation is, you understand the relative spread that we're looking at that is then displayed within an oscillator. And so if I'm going to just add our study here, our campus valuation, and this is the one that you would have, I guess. This is the one that I'm going to use now. Studies, add studies, campus valuation 2.2. Here we go. So what we're now going to do is we're not going to look at the treasuries this time. We're not going to look at bonds. We're going to look at dollar DXY as a cross-market condition for our Forex market. So what we're going to do is on show reference symbol 1 for that references the treasury market, we're going to put a false here. And on show reference symbol 3 that references the US dollar DXY, we're going to put a true. And on the length, on the cycles, we're going to put a 10 right there. Then I'm also going to double click that. I'm going to go to color or style. And on the style, I just want this line to be a bit thicker so that we can see it nicely. All right. So this is, and I'm also going to write this down for us. For Forex, we only have one cycle usually, and that is the 10-day cycle on a daily chart. Why is that the case? So there's not a whole lot more that we have to do here. Why is that the case? Why are we only working on a day and why only on a 10-day cycle? Well, because Forex is a trend market. And the lower time frame cycles are our trend following cycles. So here we only have a trend following rule, and we will not have an end of the band rule. Okay, this indicator does not do very well when we applied A against the context of trend, and B, if we use that to predict the end of the band, even on higher time frame cycles, on weekly cycles, that doesn't have a good enough consistency for us to really use that. And I'll just showcase that on the euro and maybe on other charts as well. So while on stocks and bonds, we had a 10-day cycle, we had a 30-day cycle for our trend following rules. And then we also had 13-week earning cycles as an end of the band rule that overruled the lower time frames. Here on Forex, it's a lot simpler because it's a trend market. We mostly want to trade Forex only with the trend, okay? Only with the trend. And so this makes our life very simple. Again, the 10-day cycle is right there. And then we're now looking at the cross market condition versus the US dollar. We put that as true. And so what we need to do for Forex is we look at the US or DXY, the US dollar 10-day cycle. And I guess I don't need the daily chart here. Right. And that is our only rule here. And so if the trend is up and we're looking at undervalued readings, we should look to buy. And if the trend is up and we're looking at overvalued readings, it may still work for a little bit, as here we're still in the context of a downtrend, but then later on, as the trend is shifting with continued higher lows, then eventually the overvalued readings will not work anymore. And so what we want to do in the context of this uptrend is we want to wait for undervalued readings and then buy the undervalued condition in the market. Now, if I'm just going to put lines here that we would apply with the context of trend, right? So for example, when does the downtrend start? Let's just say this downtrend starts maybe at this stage, right? We have lower highs, we have lower lows. And at this stage, we could say, well, we're downtrending. And so here we get an overvalued reading. That is a solid sell point. Then here we get close to an overvalued reading, but not quite. Here we're overvalued. That's a solid sell point. Here we're overvalued again. That's a solid sell point. Then here we're quite overvalued, but only quite, not there yet, right? We could add them and then see, you know, what our performance would be with adding them. I'll show you how to do that in just a second. And that is an interesting key takeaway here as well, where some markets may be different. Here, this is overvalued. That works out as a nice sell eventually. Then here we are not quite overvalued, but we also don't really get a sell until here. Then here we're again we're overvalued. And then we're also getting 1, 2, 3, 4, 5 days decline before then the trend is shifting. So that is a good sell point and that is a good buy point. So you can see if you apply that with the right context of trend, almost all of the time we're getting a decline eventually, especially if we're trading those levels with the right quality supply areas. There's not going to be 100% success rate, of course. And what messes up the 100% success rate on this tool is really when the trend is shifting. So when the trend is shifting and you can see, okay, here, for example, it's working, right? Here, it's not working at all, but then the undervalued here is working, but then this one isn't working. So while a trend is shifting, it can get quite messy. Here we're undervalued, that works. Here we're undervalued, that doesn't work. And then here we have a clear trend again, where if we get undervalued readings, it's working a lot better than if the trend is shifting, and or, right, and or here if the trend is shifting. So what I'm not going to do is I'm not going to put in the lines where we're going to show the accuracy trading this against the trend, because that is going to be very low accuracy. We already showed that here on the Apple example, that when we apply the trend following rule against the context of trend, we get very low consistency, and therefore there's no action. And the same applies to all of our markets. If we're applying the lower time frame trend following rule, then we should apply that with the right context of trend as well. And there we get a lot better accuracy if we applied with the right context of trend. So I'm not going to do the full analysis again. Obviously, I give you the tools to do that on your own as well if you want to. But given the short amount of time we only have together, let's save some and actually spend the time that we have on practical applications together. And so if we're now gonna, if you're now gonna continue to look at this, then we'll notice across the board, regardless of how far back you go, if you have strong trends in place and you're applying this to strong trends, then most of the time, not quite 100%, but most of the time, these areas, they end up being good sell areas. And then as the trend is shifting, if we're undervalued, then these areas end up being good buy points, and then we get messy. It gets messy a bit, and then eventually we can see, okay, the overvalued works rather well. We can see, oh, the undervalued is not working anymore. Okay, the trend is shifting. Now we're overvalued. We're going to sell with the downtrend. And then all of these trade opportunities here, as we get overvalued, turned out to be pretty good sell opportunities. And then the trend is shifting yet again, right? Trend is shifting yet again. And then down here, we would have, again, the first undervalued in a long time that then gave us a pretty good buy signal. And since today, we're not overvalued yet, right? So that speaks for the euro potentially having some more upside potential here. So what we can already put down within our cheat sheet now is that we have another primary tool for Forex, and that comes in with the valuation looking at the US dollar as a cross-market condition. And that makes a lot of sense because the US dollar is the reserve currency, and we technically trade all of our currencies against the US dollar, right? All of our currencies are quoted against the US dollar. So we are not trading the euro, we're trading the euro USD. We're not trading the Japanese yen, we're trading the USD Japanese yen. We're not trading the Swiss franc, we're trading the USD Swiss franc. So the US dollar is always either in the quote or in the base of these pairs, and therefore it makes sense that strength or weakness of the US dollar also affects our major currencies. And with that, we can also look at this cross-market condition where we look at the relative spread between how far or close together these are. And if the spread is extremely wide, given we're in the right context, these readings will give us pretty solid trade opportunities. Now, what's also going to be interesting is that we saw that a lot of times we were at these overvalued readings, like here, like here, like here, but we didn't quite touch that, right? Nonetheless, here we moved, here we eventually went lower, and then here it didn't work. So that would have been the only time where it didn't quite work. And then here also, nice sell opportunity. So with the way how this is set up at the moment, we potentially would have missed 1 and 2 trades on this downtrend. And this one, you know, if we would have taken that one, then we may have been stopped out, or worst case scenario, break even trade. But I take that as a trade-off. 1 additional loser, 2 additional winners, gives us 3 more trades overall. And so what we can do, if we notice that, then you can double click on the index and you can change the boundaries of the upper and the lower threshold. And that's where we could speak about 69 and minus 69. We're on a lot of assets, a lot of Forex assets. This may be the case that now moving this just slightly lower, the boundaries, you're now getting another trade opportunity right here. You're getting another trade opportunity right here, just bang on. And then you're getting another trade opportunity right here, which did not work out. So it comes down to the back test that you're doing to then also observe, okay, were there quite some times where we were close to the line, but we weren't quite there yet? And nonetheless, these gave us good trade opportunities. If that's the case, you can slightly change these boundaries, 69 here and minus 69 here, the upper and the lower threshold. And we incorporated these inputs to make these tools, to make these forecasting tools extremely flexible, right? Not all markets are the same. These are standardized tools, but not all markets are the same. We may want to look at slightly different boundaries and slightly different cycles, and we want to look at different reference symbols as well as we look at different cross-market conditions, depending on the market that we're looking at. So this gives you the necessary flexibility to do that if you notice something like that. Of course, that is also something that you would want to put down here. You would want to say, well, on the euro, what did we find? The 10-day cycles, trend following for buy and sell. And the boundaries that work the best are the 69 and the minus 69 boundaries, while the standard boundaries are 75 and minus 75. And so these boundaries, right, there's no magic to those boundaries. As this is an oscillator, it looks at the extremes, but who tells me that just the upper, that just beyond the upper 75 percentile, we're at an extreme, or just below the 75, minus 75 percentile, we're at an extreme. We could also be at an extreme on 65 or on minus 65. And so it depends on what you see and what you observe as per your back test. That is then going to allow you to change that right here. And you can also see to the rest of the readings, it makes barely a difference, right? Maybe here we're then slightly early. But to the other readings, it makes barely a difference, right? There's still solid sell points regardless. So we'll take that trade-off Let's put the lines lower. We get 3 more trades. 1 trade that we added is a loser. 2 trades that we added are winners. In terms of just the move that we would expect from that. And if we were to continue to do that exercise and we would just look at all of these readings, regardless of the trend context, then the accuracy would go quite a bit lower, right? It would go quite a bit lower, but even against the context here, for example, eventually we get a little bit of a rally, and then here as well, eventually this goes just sideways, and then here as well, here it works for a few days, and then here as well, here it works for a few days, then here as well, here it works for a few days, but first we take some heat, then here it goes sideways for a few days, then here it works for a few days, then here it works for a few days, then here it's the end of the band, and then here it doesn't work at all as the trend is shifting. So even against the trend, the accuracy wouldn't be out of the world bad. It wouldn't be disastrous, but we have to ask ourselves as well, what would we rather do? In this case, rather than going against applying this against the context, I would rather apply this with the context, right? And during times of a market shift, we have to work with this tool may not working for a while, right? And so there's specific market scenarios where this tool is not going to perform very well. And so, for example, if we are going to do a back test here we get a little bit of a decline and we go higher, then we decline, then here we barely scratch it again. Maybe we could move it lower, but we'll see about that later. Here, due to the 69, we're now touching that, right? We're now touching that and we get the decline. Here, again, we're overvalued, then we get the decline. Here, again, we're overvalued, then we get the decline. Then we move a bit higher, then we're overvalued, then we get a bigger decline. Then we're overvalued again here, a little bit too early this time, but eventually we get the decline. Here we get a decline for a few days. And then here, this is Corona. Wouldn't really look at this. I would treat that as an outlier, but these are exactly the times where also this tool is not going to work very well, because this works on normal functioning markets, right? If you get extreme and historic rallies and extreme and historic declines, this tool is not going to work very well. And I'll have time to showcase that on natural gas, for example, or on other commodities where when a market just goes straight up or straight down, this tool is not going to tell you very much, right? Because it always looks at these 10-day cycles, and based on those 10-day very short cycles, it's then going to tell you whether the spread based on that cycle is over or undervalued. So if in the last 10 days, you just see that for 10 days, right? And before the market has gone like this, then here, most likely you'll get an undervalued reading, and then you will stay undervalued just for this entire time because it's an out of the ordinary market move. So the tool that we have here does not cater for out of the ordinary market moves. It caters for the normal market conditions, okay? And unfortunately, we don't quite have a tool that would cater for this, or one tool that we could use to predict something like this is then the COT, right? Where we would look at the commercials or the non-commercials to see whether they're at an extreme or historical position. If they are, then we can use that as a way of potentially predicting that. But that being said, this is something that we have to put into consideration, that during times of Corona or during crazy moves, this tool will have less accuracy. Okay, this tool will have less accuracy. So we did the euro. We could also do the British pound, for example. All of the majors that are paired against the US dollar are usually going to work very well. Here we started to be undervalued, and eventually we got the push higher as well. Maybe slightly too early, but predicting the rally to happen. And here we're overvalued. Here even it worked, but this would now be a context of an uptrend, right? So context of an uptrend, we wouldn't even look at that as overvalued. We would only look at undervalued, because we want to trade that with the right context. And so I could say, well, this works very well even against the trend, but what about these times, right? What about these times? Well, here it didn't work quite well. Here it worked a little bit, and then here it didn't work at all. So my accuracy goes down. Even though it works once, I lost 3 times in a row. So I don't want to isolate this one and say we should do it. We don't use that against trend. And then if we're in a downtrending market condition, let's say, when are we in a downtrending? Maybe at this stage we're downtrending here or here. It works. And then here we get the 69 one again, right? Due to the 69, we're now getting an overvalued that produces a major sell in this market. Here we're definitely overvalued too early. But then here again, here it works pretty nicely. So we have one that's red for sure. And then here again, maybe again slightly too early, but eventually we produce this major decline. Then here again, we're overvalued. And you can see how it doesn't take a lot for us to be overvalued, right? Because price didn't even correct by a lot of percentage points. It just made a very small correction, and boom, we're overvalued. We should look to sell. Where do we sell? We sell in supply, and then it's just a matter of timing the market. Only on the wider version we would have been filled here. Trading this on the preferred version, we would have never been filled in this trade, and we would have missed out on that. But maybe, but don't want to talk about market timing. But then obviously that's an additional layer that we would have to put on top of that. Here we're overvalued again, also a few days too early, but then we produce a nice drop. Here we're overvalued again, also a little bit too early, but then we produce a nice drop, right? So what can we state with that? We can state again also on the British pound with the right context. This works extremely well. What about the undervalued readings against the context? Well, let's look at that. Let's take a look here. It didn't work. Let's take a look here. It worked a little bit. What about here? It didn't work at all. What about here? It worked a little bit. Here, it didn't work at all. Here, it worked a little bit. Here, it was too early, but also being too early, it didn't really work a little bit. So it didn't work. Here, we were again too early and it didn't work. Here, it worked a little bit. So you get the point again, right? So here, using it against the trend, we fail most of the time. The times where it works a little bit, but applying this with the right context of trend, it works most of the time, and it produces some large moves in the process. So on the British pound as well, as we just do a quick back test, and please feel free to do a more comprehensive back test from your side. For sure, that's going to help you with the understanding of charts and this tool. So British pound. We can use the same boundaries. We can use the same 10-day cycle trend following rule as we used for the euro. What else could we look at? Swiss franc. So here it works pretty well. Here it works a little bit, but not that great. Here it works all right. And then here it doesn't work at all. What's the trend condition? Well, the trend condition is probably, I would say, down, right? So most of the majors will be trending down against the US dollar. So most of the time we would look at overvalued rather than undervalued readings, unless we really see that the trend is shifting. And then if the trend is shifting, we can then look at undervalued readings, and then we should get some nice rallies, potentially going to be overvalued soon. And so here, if we're going to look at the overvalued readings, here we're maybe piercing that. We get a little bit of a decline, go higher, and then we get that push lower. Here it's just bang on. So let's just look at the overvalued readings with that context. And we could even state, well, here we could even put a red here and say, well, we would have tried to get in, and then maybe we would have tried to hold that, then this would have gone against us, and then it would have taken us out. But here, for benefit of the doubt, here it worked pretty well. Here it worked a little bit too early, but then it worked out pretty well. Here, just bang on. Here, way too early. But then eventually it also worked. Here again, bang on. I'm moving this to here because this is really where it started. So here, bang on. Eventually we created that decline. Here, bang on, decline. Here it didn't work at all. Here, just a bit too early again, right before we get the decline, but we do get a nice decline here. Here, bang on. Here, again, few days early, but then bang on. Here, it didn't work at all. And that is the area where the trend condition changed. And so that makes a lot of sense here as well. And so looking at this again on the Swiss franc, we have a few more potential losers that we have on the others, but overall, it's still a valuable tool for us to use on the Swiss franc. And so you could now go through all of these Forex markets, and we could do the Japanese yen here as well, because we already have it part of the list as a last one, and you will see very similar results. Okay. Generally speaking, the more influence Nada, yes, I am speaking. You should hear me. Does anyone else have sound problems? Okay, another. Maybe log out and come back in. As a rule of thumb, you can say that the more weight the US dollar has and the more impact the US dollar has on a certain currency, the better this tool is going to work, generally speaking. So for most majors, this tool is going to work pretty well. On other pairs, like for example, if you were to look at the USD Mexican peso or at the USD ZAR, yes, a strong or a weak dollar has an impact on those currencies, but they do their own thing basically most of the time, right? And they're either very strong or very weak, depending on if you use the US dollar as a quote or as a base. However, on most majors, there is going to be some merit to this tool. Now on the Japanese yen, you will see that here, for example, we didn't get a strong buy, or the buy just came a bit too early, and then we stayed undervalued. Eventually, we got a little bit of a rally, but not too much. Then we almost pierced this area up here, and then we got a decline here. Here we're overvalued, and then we got a little bit of a decline, but not too much. Here we weren't undervalued, we're undervalued here, and that's just way off. Overvalued also too early, but then it produced a nice decline. Overvalued too early, but then it produced a nice decline. Overvalued, eventually we produce a nice decline. Overvalue here again too early, and then eventually we produce a decline. So it does work to an extent, but it doesn't work as great as it would with the euro. Here it works quite all right. Here it doesn't work. And so the key is, again, we can see that it doesn't work here. It's maybe too early. It's most of the time too early looking at the Japanese yen. So as we look at the Japanese yen, it's like, yeah, we can look at it, but we have to understand that, A, if we apply this against the context, this has basically no merit whatsoever, because these undervalued readings, yes, we're undervalued, but price doesn't do anything. It doesn't even stall for a bit, right? It just continues to decline. So if we apply that against the context, opposite to the euro, for example, where at least price stalled for a little bit most of the time, or we got a little bit of a move from these undervalued readings against the trend. But in this case, it's just, we look at undervalued here, and this market just completely collapses. So this is also a sign that, this market is kind of doing its own thing. It doesn't really look at the US dollar that much. It just behaves its own. It just is its own market, basically. And that the Japanese yen is its own market makes also a lot of sense, because if you look at the cross pairs like Euro JPY or British Pound JPY or Canadian JPY, these are some of the most volatile Forex markets. Why are they the most volatile Forex markets? Well, you're not trading two heavily positively correlated markets. Well, if you trade, for example, Euro GBP, it's not as correlated, because anyways, the euro moves and behaves similarly to the British pound. So yes, during times one outperforms the other, but as you would look at the cross pairs, the biggest bang for your bucks are going to be the ones where you trade a strong currency versus a weak currency. Most of the time, that's possible if you trade the Japanese yen as a cross pair with one of the other majors, so Euro JPY, GBP JPY, because it does its own thing, right? Euro US dollar, British pound US dollar, they both move and they both are impacted by strength or weakness of the US dollar, or Swiss franc, US dollar, Swiss franc. Swiss franc is impacted by the strength or weakness of the US dollar. And so if we're going to look at the Japanese yen and doing this analysis here, we already know, well, it's not impacted that much. It is eventually, if we apply it with the right context, but there may be other markets where if we use this tool, it's just better than using it for the Japanese yen. So if I'm gonna put this here on the Japanese yen, what I would say is it's either an odds enhancer if we apply it with the right context, or it's a secondary tool, right? And so here it's either an odds enhancer or it's a secondary tool. And here we could say, well, we're going to look at the non-commercials, and then we're also going to look at over or undervalued. And we're going to use that as an odds enhancer to potentially, if we find a good setup, to potentially trade that setup. And we have to know that very rarely it's bang on accurate. Very rarely once it flashes, we have some time to then position ourselves with this specific market right here. So now you saw 3 markets. Let's check. Now you saw the British pound and the euro and the Swiss franc, where this works extremely well. And then on the Japanese yen side, we saw that it doesn't work that well. So rather than this being a primary tool, right? If we were to use it as a primary tool, we would be doing pretty badly probably. Rather than using this as a primary tool, we use it as an odds enhancer to say, well, if this is the case and I have other metrics that are flashing green as well, like the non-commercials at an extreme and breaking out, then I could look to trade this specific currency. And so by just simply looking at this and backtesting, again, just your trend condition rule, that's all you have to backtest. You don't have to backtest anything else. Of course, feel free to do so, right? Also backtesting the 30-day cycle and backtesting the weekly chart, and maybe you find a cycle that works extremely well that I just oversaw. And what I basically want to do is I want to give you the tools and the know-how to do these and to perform these kinds of back tests on your own, right? Because I may not have all the answers for all of the markets under the moon and under the sun, right? These hundreds and thousands of markets that we're able to trade. I may not have answers for all of them. I only have the answers for some, but even if I give you the answers for some, there's a lot of merit to you performing the backtest yourself to really understand, okay, how does price flow and interact with this cross-market condition and these boundaries within these oscillators and the context of trend, and how does price interplay with that, and what affects or what impacts price the most, right, during which condition. And if you were to go back to that sheet here, and you were to go here and you just put in euro uptrend, exactly the same thing that we did for Apple here. And then what I did very quickly is you would get similar results. The high accuracy that comes in here are the ones here, the trend following, downtrend, trend following sell, high accuracy, uptrend, trend following buy. So we buy undervalued with an uptrend, high accuracy. We sell overvalued with the downtrend, high accuracy. If we apply it against the context, low accuracy, what would we rather do? Well, no action, no action if we don't have a clear trend, and then we apply the trend following rule if we have a clear trend, and the end of the band is something that we only do for stocks and bonds. So now lastly, what else can we do? We could look potentially at commodities as well. So which one are we going to use? Let's use gold. Now we don't use gold first, we use silver. At SI equals 120 XN. I'm too lazy to put this into my chart. What I'm going to do, or wait a second, let's do that. Just going to copy that across. Okay, hold on a second. I just don't want to mess up my worksheet here. So I'm just going to use this window. Perfect. I must have some link somewhere. Ah, here. Okay, once more. Here we go. As we now look at commodities, and you'll see oftentimes on my valuation, what I have is I have all three of them displayed most of the time, but I'm only using the one that is most relevant to that specific market. If that confuses you, especially in the beginning, you can turn them on and off according to your liking. That's something that I would recommend. Later on, as you get more advanced, you can just always just keep all of three of them in. You know the colors, you know that purple is the dollar, you know that the gold is the yellow, the golden line, and that interest rates are the white lines, or depending on how you're going to code them. On the preferences here under color. But if you want to make your life very easy in the beginning, you could just put all of them to false, apart from the one you leave as true, the one that you want to use. In this case, we want to show reference symbol 2, which is gold. So what we can do is we can use gold as a ultimate storehouse of value to measure valuation on most commodities. Okay. This is not going to be our primary tool, but this is going to be our secondary tool, okay, or our odds enhancer. So how would we again go about this? Well, we would again check the different kinds of cycles and the daily, the 10-day versus the 30-day cycle to see how how much merit there is to this specific tool. And if there is no merit, for example, right, if there's no merit, which could also be the case, then we also don't have to use it. And so what I want to show you is that if we're going to look at this on a 30 or a 10-day cycle, you will get very similar readings with that. I do prefer the 10-day just because we get slightly more. And I do prefer the 10-day because we don't want to use this as a primary decision-making factor. We only want to use that as an odds enhancer. So here, for example, we turn overvalued, nothing really happens. We stay overvalued, and then eventually we're seeing the decline here, but not so much, but maybe we're producing a bigger decline here. This undervalued reading was the low of the low here. So if we, for example, were to see commercials buying down here and we're undervalued against gold, the ultimate storehouse of value, then we could look to buy silver, kind of as an additional odds enhancer, as a fundamental odds enhancer. Here we're undervalued, we rally for 2 days, but nothing much happens. Here we're overvalued, nothing much happens. Here we're overvalued, nothing much happens. Then here we're undervalued, we produce a major rally in price. So let's just put, regardless of the context of price and the trend, I'm just going to put a few lines in, and I'm going to mark them green if they worked, and I'm going to mark them, I'm going to leave them as is if they did not work. Here we're overvalued, we get a nice decline here, though just for a little bit. Then undervalued way too early, don't want to count that as a good buy. Here we're starting to be overvalued. Then we also get the nice decline out of that nice supply. So for sure, in the context of we're getting overvalued, yes, too early, but anyways, we're shorting in supply, giving that context. This works out quite nicely. Then undervalued, we don't work, not quite overvalued. Undervalued, it doesn't work. Undervalued, it works like a treat. Overvalued, it works like a treat. Undervalued, eventually we get a nice rally, but maybe too early. Here overvalued, way, way, way off. So you get the point here that there are some times where it works, but it just works as many times as it doesn't work. So the accuracy is not very promising. And that's why it's not a primary tool for us, right? However, if I'm undervalued here and the commercials are buying, then this is an additional odds enhancer for me to look and position myself and get into this market. If I'm undervalued, but the commercials are selling, I don't care, right? This doesn't overrule the COT. It's only an odds enhancer. And that's going to be the same for all of our commodities. And during times of major moves, this thing will just be undervalued way too early, and then it will be undervalued for a very, very long time until finally we get a move. So again, we're looking at finite markets here. We can use the valuation as we look at the storehouse of the ultimate storehouse of value, gold, and we can use that to value finite markets. But as we do that, And as we see, there are going to be limitations to that. And the accuracy is maybe going to be even less than 50%, but sometimes we can see it just works so beautifully. Well, the times where it works so beautifully are the times where we have the right COT setup as well. So really what we need most of the time is only the COT. We're going to use this here as an odds enhancer though, or as a secondary tool. In this case, I like to use it as an odds enhancer rather than a secondary tool. I guess if you ask me what is the difference here on secondary versus odds enhancer, well, if it's secondary and it flashes green and one is neutral, then you could go about trading this based on your secondary tool. However, if it's just an odds enhancer and this is green and this is neutral, it may not mean that you want to use that as a standalone, right? So here, this is not a standalone. The secondary could be a standalone if the primary doesn't give you the opposite reading. And so that's the difference. One example where you will notice the limitations of that specific tool is if the market goes into extreme moves like it's done here and like it's done here, looking at the valuation is not going to do you any favors, right? Yes, maybe eventually these undervalued readings are then going to produce also some rallies, or it's going to stall price for a bit. But most of the time, when we get these kinds of moves, there'll be no tool that I know of that can cater for that, right? And that's also not something that I want you to base the statistical probability of success and accuracy on, right? If you look at something like this, you're like, hey, this tool really doesn't work. Yeah, of course it doesn't work, because these kinds of moves and then trying to get the bottom of this, there's going to be no tool that you can find that can do that accurately, right? That can do that accurately. And so also here in this case, huge moves, right? There's not going to be a whole lot that we can do here, that we can use this on. We're always going to be way too early, or we're always going to be way too late, and so on and so forth. However, if, let's say, there are normal conditions in the market, then we can use this tool, right? So for a very long time in natural gas, overvalued, we got a decline, undervalued, just bang on, overvalued, just bang on. Then we go into a downtrend. Then we look at the overvalued readings, bang on, decline, overvalued, bang on, decline, overvalued, slightly too early, but then eventually bang on, decline, undervalued, too early. Doesn't work. Overvalued here again, bang on, decline. So 2 times where it didn't work. With the right context, still a downtrend, selling, a little bit of a decline, selling, a little bit of a decline, selling, a bit too early, but then we get the decline. So you can see that for a very long time, this actually had merit. And then all of a sudden, natural gas just does something completely crazy, and it makes a moonshot followed by a crazy decline. So when you see markets that go like this, and then like this, this is not going to work very well. What you want to have is you want markets that move like that, because then you can actually look at cycles. If a market just goes straight up without barely any corrections, or if the corrections are always very steep and sharp, and then it just goes straight down for days and days and days and days, this will not be a very good tool to trade off from. Even though it seems like now the overvalued readings and overvalued seems like within that very strong downtrend, they still have merit, but then also we didn't get overvalued for so long, right? And that makes sense, because how can we get overvalued if every day is just down, 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 down? If based on the cycles, that's the normal thing, that we go down, 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 then the minute we get a little bit of a rally, we should be overvalued. And then we go down, 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 down again. And the further we go down, the more this down becomes normal. But then eventually what usually happens is this then just goes up, 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 up. And finding that point where it goes then up, 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 this tool is not gonna help us with that. So important for me also to show you the limitations, and then how you're gonna use that also, and how then the backtesting is going to help you in identifying, okay, what markets based on your cheat sheet am I going to use this on, and what am I not going to use this on. So on natural gas, at the moment as it stands, even though if we had done this analysis like 3 years ago, we could have said, well, it worked pretty well, right? But during the current market conditions, it just does not work at all. So we would also not really look at it when we analyze natural gas. Maybe we could check it out on crude oil. As the last product here, just putting in these potentially overvalued, not quite, but close, and undervalued and overvalued, and then checking how well they hold up, not so well, and a 10. Here we go. Okay. Overvalued, producing a decline, undervalued, producing a rally, overvalued, producing a decline, undervalued, completely off context of a downtrend, overvalued works, overvalued works, overvalued works. So the same applies here. In the context of a downtrend, we can use this to trade the trend. Okay, on crude oil here, it's very clear. This is against the trend. This is with the trend. This is with the trend. This is with the trend. Clear downtrend. And this would be with the trend. Here it works, yes, but this would be a complete counter trend trade. But what did we also know down there? we knew that the commercials were at historic extremes. And so here again, this reading we could use as an odds enhancer. Better to have it than not. And then here, if price goes down and we're again down here, we can use that with a potential uptrend. And then whenever we get undervalued on an uptrend, we're just going to continue to buy and buy and buy. While if we're downtrending, we're going to continue to sell, sell, and sell. And if we're uptrending here, undervalued, we produce a massive rally. Undervalued, just bang on. Undervalued, quite nice. Undervalued, beautiful. Undervalued, too early. Undervalued again. This time around, we produced a rally. And then we're undervalued again here, still with the uptrend. That's working out quite nicely. Then here we're still with the uptrend, right? We haven't broken any of those lows, so we're still with the uptrend. Also produce a major rally, produce a rally, produce a rally. And then eventually the trend is shifting. Okay, we may try this here, and then we may get stopped out here or not. Maybe we have a break-even trade or we have a small winner. Regardless, sign the trend is shifting. The undervalued readings are taken out. We're breaking those lows here. And then eventually the overvalued readings are working out quite nicely. So what we can see is that on crude oil, applying it similarly to Forex with the trend condition, it works extremely well. There's high accuracy in doing that. So as we do crude oil, we haven't even talked about. So crude oil is a finite market. We would use the commercials on crude oil. But we would also use, well, we have to leave those blank because this is a sign for me that I have to cover it as well. This is now a secondary tool for us. Okay, so this is a secondary tool for us. And what we're operating in is we're operating on 10-day cycles with normal boundaries. We could use as a secondary tool or odds enhancer. Both would be fine here in this case, but it's so strong that we could use it as a secondary tool, meaning that if all else is neutral, right? If all else is neutral, we're in a downtrend, we're overvalued against gold, and we're in supply, you have the license to sell. If all else is neutral, we're in supply and overvalued, you have the license to sell. If all else is neutral, we're overvalued and we're in supply, you have the license to sell. Okay? Similarly, if all else is neutral and we're undervalued in the uptrend, you have the license to buy, right? You have the license to buy, and then it just becomes basically a market timing issue, whether we get a handle on this trade or whether we are too early or whether we are too late. And so in crude oil, that's what now also using this tool and looking at the market, that's now what we would say, well, we potentially are breaking the downtrend because we have broken some of these highs. Now we're pulling back. If we're undervalued and in the level of demand, we have the license to buy. So we covered quite a lot so far. We talked about two major setup tools. We talked about the COT being most important for our finite markets. We talked about the valuation being most important for our infinite markets, for Forex and equities and stocks. But we also talked about the potential relevance on the COT for infinite markets. And we talked about the potential relevance for valuation or for finite markets. But what is most of the time, 95% of the time, what is going to be the case is the COT will be your primary tool for your finite markets, and the valuation will be your primary tool for your infinite markets. 95% of the time, that's the case. Where it wasn't the case, one example was natural gas that we looked at, where the COT wasn't really so relevant. If we see that, then we also know, okay, great, what else can we use? Well, can we use valuation? Also doesn't work that great. So maybe we'll just gonna have to look at true seasonality to get an understanding of how to potentially predict or do the best at predicting the future when it comes to those markets like natural gas. That is where next lesson will come into play. So next lesson we'll start talking about true seasonality. And what true seasonality is going to do is it's going to identify favorable seasonal time periods or seasonal reoccurring pattern that we can then identify with the help of our indicator, and that we then can leverage on most of the time if one of those primary setups are in place. So for example, if I'm looking at silver and the commercials are buying, I know that I want to buy, correct? Now, the question is, when do I want to buy? That's where true seasonality is going to come into play. So here we would say Christmas time, or we would say December, January, Feb are going to be bullish months for us to buy. And then when would we want to sell? Well, we would want to sell in May, potentially, and or in November, right? And so these will then give us times of the year where these markets are most likely to decline or most likely to rally. We'll talk about the benefits of true seasonality. We'll talk about the disadvantages of true seasonality, how most people look at true seasonality, how we will look at true seasonality, and why our seasonality indicator is called true. Very important. We've spent so much time on backtesting, right? And backtesting is key to market success, because backtesting allows you to understand what works and what doesn't work and how well it works. And so if we apply a backtest on true seasonality, we actually have a true backtest. And I'll explain that next time. It's very vague at the moment, but I'll explain to you next time what I mean by that exactly, and then how we're going to use that in line with our tools right there. So most of the time, true seasonality will be an odds enhancer or a secondary tool. Very rarely it will be a primary tool. It's only a primary tool in the case of when we have nothing else to work on, right? Like in the case of natural gas, where it's like, okay, the COT doesn't work, okay, the valuation doesn't work, doesn't help us. So let's see if maybe we can look at true seasonality to get at least a glimpse of what the future may have in store for us. All right, today was a shorter lesson. I'm going to end the recording right here. Feel free to hang around and ask some questions. Thanks for watching and staying until the end. I'll catch you all in the next few days. Thanks again, and ciao.